The following pre-recorded program is sponsored by Adams Financial Concepts. Welcome to About Money, a different approach to investing you won't hear anywhere else. Your host, Mike Adams, is a registered investment advisor and works with investment portfolios exceeding over $100,000 in net worth and has a proven track record of managing long-term investments, surpassing the markets in the long term. The information shared in the following program is for educational purposes only, and any investment advice given may not be suitable for all investors. And now, here's Mike.
As we do on each Saturday, because this is the answer about money. So, my client asked, are we millionaires yet? She was kind of joking, but it was at an event I hosted. I was chairman and president of Seattle Theater Group, the Paramount, and the Moore, and the Neptune. And I hosted events for clients and prospects. And in this case, she was invited. She was a fairly new client, and she brought some friends as well. And she joked in front of them, are we millionaires yet? It was just the fall of 2001. We'd just come through the dot-com bust. She was joking because she just started with $173,483. $173,000 in May of 1999, just as the market was getting to a peak. And here we were 18 months later, and actually her account was down. It was at $153,950. Gone from $173,000 to $153,000, which wasn't bad given all the times, but she wasn't a millionaire. And it was, at that time, a joke at that time, but it isn't anymore. She's taken $825,000, more than $825,000, out of the account over the past 21 years. And the account, as of the end of June, stood at $2,078,221. The account, the $173,000, had grown over the total period of time. In 21 years, the total account had grown to $2,900,000. And that was not withdrawals at the very end. Those are withdrawals as she went along. So that $173,000 had grown to $2.9 million, of which she had taken out $825,000. She'd put in $173,000, taken out $825,000. Think about that. But that's only part of the story, because she gifted $5,000 to her daughter when her daughter was just 18. She gifted it to her daughter to say, you should begin to think about investing. Now, her daughter's added money as her daughter has worked and had very good paying jobs. Her daughter added to that $5,000 another $1,082,000. But her daughter's account now stands at $2.37 million. So her daughter's account has grown from $1 million to $2.3 million. As she's added money over the years, the account has grown. That is, for me, a case study that demonstrates several things. It demonstrates, number one, the impact of compounding. Albert Einstein called compounding the eighth wonder of the world. He elaborated by saying, and I quote, he who understands it earns it. He who doesn't pays it. You know, Einstein was referring to compound interest, and as Warren Buffett put it, another quote, my wealth has come from a combination of living in America, some lucky genes, and compound interest. And if you think about it, 95% of Warren Buffett's wealth has come after the age of 65. Think about that. 95% of this wealth has come after the age of 65. And he's approaching 90 now, or he is 90. I don't know exactly, but he's close. It is the impact of investing and the compounding interest. You know, during that period of time, during the 21 years, the mother invested at a time just before the dot-com bust. She's ridden through the Great Recession. She's ridden through the pandemic time, and still, 173,000. She took 825,000 out, and she has over $2 million in the account. Think about that. Think about the impact of compounding and the growth over that period of time. That's the first thing. We've gone through setbacks. We've gone through drawdowns. We've gone through some really tough times. But through that all, we were fully invested. We never sold out. We never tried to time the market. I never tried to say, the market's looking lousy and bad. We need to sell out. No, the account went down some 30% during the Great Recession, but it recovered. It went down during the pandemic, but it recovered. It had gone down. When she asked that question, it was already down over 10%. That was where it stood. Going through setbacks, going back, those down times, we'll ride through those because we don't want to miss the best trading days. You know, there have been a lot of studies that have been done showing that if you miss the 10 best trading days in 20 years, you cut your returns by 50%. That was a study that was published by Stock Traders Almanac for the years 1994 to 2014. During those 20 years, missing just the best trading days cut your return in half. Cut that return in half. Think about that. If we would have missed 10 best trading days, instead of having $2 million, if she had taken 800,000 out, she would have had 600,000. That's just off the top of my head thinking about it. But going through those times, missing out the best trading days is detrimental to a portfolio. And yes, it's also true that if you miss the worst trading days, you can significantly improve your portfolio. But then you have to guess what are going to be the worst trading days, and you have to guess which are going to be the best trading days. You have to guess and make sure you're out of the market on the worst trading days and make sure you're in the market on the best trading days. And I don't know anyone who's done that successfully. And if they had, they would be publishing their results. We've never seen anybody publish those kind of results. So it was two things. It was actually three things. It was being in the market the full time. It's understanding the value of compounding. And it is being with Adam's Financial Concepts. The Financial Advisor magazine comes out. It's delivered to financial advisors. It has all sorts of articles on financial advisors and financial planning and growth and who's coming and who's going and who's buying, who's selling. It has all those articles. It has ideas on building portfolios. It has ideas on mutual funds. It has all those ideas. But one thing they do every year is they publish the top registered investment advisors. Pardon me. And in that list, they list all the advisors up who have $500 million in assets or more. And there's 433. That's significant. There's over 12,000 registered investment advisors in the country, and 433 have 500 million or more in assets. 332 have $1 billion in assets. Those are big firms, and they're growing at about 20% per year. But when you really look at what's happening, they list not only the firm's growth, they list the growth in client assets. And I looked at that, and I took the top 100 firms, all with over $1 billion in assets that they're managing. And those firms, with $1 billion in assets that they were managing growing at 20%, they also published how their clients are doing. And the average return in 2020 was 3.7%. The market was up 16%, and Adams Financial Concepts were up 77%. And yes, it was an unusual year, but if you look at our track record, we've been over 21% since the Great Depression, Great Recession in 2009. We've been over 21%. We're outperforming the Standard & Poor's by 4%. That is something compared that to how the big firms do. Big is not necessarily better. Big is not better in this case. We're taking care of our client assets. We grew 83%, significantly above that, but client accounts grew 77% of that 83. The big firms grew 20%, but their clients only grew less than 4. To me, that's, I don't want to say repulsive. It just doesn't go to show. But I can almost assure you they do not have stories like I just related about the mother and the daughter. Those are things that we do because we understand compounding, we understand staying in the market and not missing the best trading days, and we understand that we have a passion for creating wealth. That's our focus, is not creating bigger firm. It's a passion to create wealth for our clients, because if our clients do better, we do better. That's just automatically. We're not trying to go out and get a lot of new clients. We accept new clients. We're building new clients. But our focus is on building client portfolios, not just building a bigger firm. All three of those go together.
Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
Taking care of business.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
Well, I shared a story in the first part about a client and her daughter. I want to just finish by saying one more thing about that. The mother's account grew from $173,000 to $2.9 million. She took $800,000 out over a period of time. The daughter has put in over her working lifetime about $1 million. Her account stands at $2.3 million. This past year, the mother or the granddaughter, the mother's daughter gave her daughter $5,000 to start her on investing. It's the third generation with Adams Financial Concepts. I'm very happy about that. We have a number of third generation people that have been with us. So I just wanted to finish that segment. I want to go on and talk. We've been in a bull market, a secular bull market, since 2009, and a lot of people are saying the bull market is getting old in the tooth. It's having its struggles. It has the volatility is growing. Prices are problematic. I just want to remind some people about some of the things that have been said. Andrew Roberts of the Royal Bank of Scotland said, the banking system is on the precipice. It's on a cliff. It's ready to tumble over. And you can think the unthinkable of what's going to happen before the end of the year. Now, he wasn't talking 2021. He was talking 2010. He was expecting the whole market was going to take a huge drop. Didn't happen. Mark Faber, who has a reputation of being Dr. Doom, in 2009 predicted hyperinflation with the Fed putting money into the economy. It was going to result in hyperinflation. Inflation was going to run 100% a year. Didn't happen. But by 2013, he had changed his tune and said, in 2013, we're going to have a 1987 type crash, 30% in one day. No, we didn't have that either. Michael Lombardi of Profit Confidential came out and said, you know what, there's going to be a great crash this year. We could see the Dow at 1,000. The Dow at 1,000. Think of what that would do and the devastation that would be in the market. Of course, he was saying that was going to happen by the end of 2013. He called and wrote a book called The Great Crash of 2013. Of course, we know how well that forecast worked out. I talked about Jerry Robinson's book called Bankruptcy. That hasn't happened either. Daniel Park, you can go down the list of people who keep predicting that this bull market is going to come to an end. It is a market which they say has been running for so long. It just has to come to an end. What goes up has to come down. So let me give you my full thoughts on the whole thing. John Templeton said, and it's really worth keeping in mind, bull markets are born on pessimism. They rise on skepticism. They mature on optimism. And they die on euphoria. Where are we? When you're hearing people talk about the great crash, when you're hearing about people talking about the market rolling over and Dow 1000, we're still in a skepticism. We haven't reached the optimism. When we begin to hear people talking about Dow 300,000, then you begin to wonder what's going to go on. You know, Harry Dent wrote the book in the 90s saying Dow 35,000. Well, actually, it turned out to be right, but he expected it to happen 20 years ago. When you begin to hear that optimism, when you begin to hear that optimism, that euphoria, you know then we're coming to the end. But we're not there yet. We're still there on skepticism. So I want to paint a picture. I want to give you a picture of some history, because history doesn't repeat, but it rhymes. In 1966, the Dow hit almost 1,000, 999.6, and then it started to drop off. It had risen 1941 to 1950. The Dow went from 100 to 200, but from 1950 to 1966, it rose from 200 to 1,000. It was a tenfold increase in those 26 years, and in that 16 years, it was a fivefold increase. You know, it took 25 years, 26 years, a little over 26 years, for it to increase fivefold. It was the end of World War. It was the beginning of World War II. It was the end of World War II. It was the GIs coming back, starting school, doing higher education, going back to university, going back to college. It was the GIs starting to buy homes and a home building spree. It was building the interstate. It was all of that taking place. Disposable income and debt was growing. In 1966, it peaked, and then it dropped about 20% by the fall of 1966. Then there was a rally, and the Dow began to climb again. It began to climb from the end of 1966, when it had fallen off 20%. It began to climb again until late 1968, a period of about 2 years. It climbed back to 1,000. But in the last couple months of 1968, the market again began to fade. And by mid-1970, it was down 30%. But then another rally began to happen. And that rally took it up to 1,000 again at the end of 1972, only to see the market roll over again. And by mid-1974, it was down 40%. But by early 75, it was back rolling again and up to 1,000. And then by 1978, it had rolled over back down to 780. And 79 saw the 70-80, and something began to happen because the Dow began to rise. And in 1982, August of 92, it set a new high above 1,000. And it continued to go. But all during that time, between 1966 and 1982, you had the people calling for the end. It was Business Week that came out and said the death of equities. Very famous cover of Business Week magazine saying the death of equities. Equities and stocks, they were done. They were completely done. You had Dines predicting again that things were going to roll over. You had Proctor and the Fibonacci curve predicting things were going to roll over. Even back at that time, predicting that Dow was going to be down to 1,000. But it didn't. In 1982, it started to march upward, and it would hit, by the end of the century, it would hit over 10,000. It would hit over 11,000, growing from 1982 from 1,000 to over 11,000. And actually, if you look from 1979 to 2000, it was up 17% per year on the average. If you look at where we are today, we're up 16.3% and continuing to grow. And this year is going to be a knockout year. We're up 18 or 19% so far in this year, and we haven't finished off. We're going to have a very good year. We're going to push it maybe to that 17% that we saw during that time. That was a secular bull market, and that secular bull market lasted 25 years as well. We're just in the 12th year of the secular bull market, just in the 12th year. What if we have another 12 or 15 years to run on this market? And certainly there are reasons to believe that that's going to happen. You know, in September of 99, I was asked, well, back in the 90s, I was asked to give talks to University Rotary Club. And in September of 99, I talked about bear markets versus bull markets. And I said that the bull market had lasted from 1978 to 2000. It was 22 years at that time, and it had grown more than tenfold. I asked about a bear market following a bull, because by that time, things had turned euphoric. People were talking about real estate on a computer rather than talking about sales, talking about revenues. People were talking about the internet. They were talking about the death of brick and mortar, and they were talking about the internet. And yeah, they would be right. But at that time, the internet stocks were flying high without sales, without earnings, just an idea. Companies were coming public with no more than a 3-page business plan. Just put .com behind the name and the price would soar. There was a machine shop, had nothing to do with the internet, wasn't connected to the internet. But when they came public, they put .com behind their name, and they got 2 to 3 times the IPO price they would have gotten without the .com behind it. That was the euphoria that was happening at the end of the 1990s. As that secular bull market came to an end, it was euphoric. The stock market was up like 44% in 1999, only to roll over and be down 38% the following year. But that's where we are. We're in a secular bull market, and you should wait for the euphoria before you begin to fear the bear market. That's just a little history, wanting you to know where things are going. That is what's going on. So don't go away. We're going to be right back after this commercial break. I'm going to talk about sales of something that were up 39% in the second quarter. Don't go away. Be right back.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
Taking care of business.
About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
So I want to talk about something that their sales were up 39% in the second quarter of this year. 39%. It was unbelievable, and especially when you consider what they are. If you've been listening for some time, you know that I do not like annuities. They have their place. For example, I had a relative who, when his father died, they sold the house, took the money, and within 2 years it was all gone. He got a settlement for an on-the-job injury, and he talked to me about where he should invest the money. I recommended for them they put it into an annuity so that they couldn't go through it in 2 years, but it would give them some income going through the remainder of their life. That's a proper place. But for most people, I'd rather die than sell most people an annuity. I don't sell annuities, and if you've been listening to me, you know that I am so opposed to annuities. It doesn't take a lot of information to know that. There's a book written by Helen Owen, I've mentioned it before, Pound Foolish, Exposing the Dark Side of the Finance Industry. And she says, when she talks about annuities, there's two things to know about annuities. First, they're increasingly sold to baby boomers worried about running out of money. And right now, the number one concern of every age group is running out of money before they retire. And secondly, they're so complicated, so difficult to understand, and so many financial penalties that even Susie Orman, who is not a favorite of mine, even Susie Orman doesn't agree. I don't agree with a lot of what she says. But Susie Orman and many other experts say annuities are sold for one and only one reason, and that's to make money for financial advisors. They're rarely in the best interest of clients. A few, but very few. Rarely in the best interest of financial advisors. Or of clients. They make money for financial advisors. Oftentimes, the commissions are anywhere from 4 to 14%. So there's a huge emphasis on selling annuities to earn the revenues. Putting clients into annuities to generate revenues for the financial advisors. But recently, there was a case that came up on Pacific Life and the PDX product. They were being sued, and there might be no better illustration of the Pacific Life Universal Life Insurance thing. It's not an annuity, but the same things apply to annuities as apply to Pacific Life. And it gives great insight to insurance companies and agents. And it was a class action. You can Google Pacific Life and look at it. It was a class action, the Hong Lee versus Pacific Life. Google it and read the whole thing. It'll terrify you. It'll especially terrify you if you've bought an annuity. When people come to me with annuities, I recommend they sell the annuity, take the penalty, take the surrender charge, because you can generally, within a year, make up the surrender charge and then go on to better things. But in the case of Pacific Life, they were being sued for fraud and deceit, intentional misrepresentation. They breached their fiduciary duty. And that's saying they did not do what was in the best interest of their client, the best interest of the people who were buying it. They're accused of professional negligence. You can look at it. PDX, Universal Life Insurance. It was the most risky and the most leveraged and almost impossible to understand. Actually, it was impossible to understand, even by the regulators who looked at it. And it was impossible for agents not to sell because their illustrations were the best in the industry. The tables and agents would show you how that policy would do over the next 20 years, and they were phenomenal. They claimed to produce outsized returns when they could actually know that they would not. You know, At Adams Financial Concepts, we put up a performance. You can go look at our website and see how our performance has been. That's not a projection. It's not back-tested. It's not hypothetical. It's not a model. What we put up is the actual performance of our clients. That information is taken from the custodian by Morningstar. They calculate a performance report for each of the clients. That's all compiled into one composite number, and that's the actual amount our clients are seeing. That is after all the expenses, after all the fees, after all the costs are deducted. That's what the clients are actually seeing. But what Pacific Life did, this PDX product, what that product did is they forecast into the future how annuitants, how people that were buying these annuities were going to do with their money. And those returns were far outsized. They were projections into the future, and they used an index to compare it. And to calculate their performance and how they compared to the index, they used something that was mysterious called a performance factor. Nowhere in their literature does it describe what the performance factor is or how it's derived or what the formula was even used. But they use that. They take a performance factor. So you take the amount of the value this year and you add the performance, you multiply it by the performance factor to get next year. Then you multiply it by the performance factor to get the following year. Then you continue to work that out, but nowhere does it show what it is, what the formula is, how it's derived, or why it's even valid. And they go further to talk about using call options, which they estimate will generate 50% per profit on every single transaction, and will continue into perpetuity. They expect that they're going to make 50% on call options, and they use that to justify very high fees. So not only do you have projections which are based on some performance factor which they don't define and which nobody can figure out, which they don't give the formula, but they also say they're going to use options, and those options are going to return 50% per year. Anybody that's returning 50% per year? We did 77% in 2020. That was so unusual. That's not something I would project into the future. I wouldn't project half of that into the future. We project we will be happy with 15% a year. We've been doing 21 since 2009, but I would be happy with 15% going forward. They're projecting 50% per year. And those are the illustrations they use. That's what the agents come out and say, this is what your policy is going to do. This is what the annuity is going to do. It's going to grow 50% a year. Do you know how fast that can turn? How fast that can turn 100,000 into 10 million? Yeah, 50% a year. Anyway, that meant that your policy was doubling, more than doubling, every year. So think about it. Think about that, doubling every other year. So if you bought a policy and spent 1 penny to buy a policy, and you had that policy for 60 years, you know what that policy would be worth if it grew at 50% a year? $10 million. Think about if you put 10,000 or 20,000, you can begin to see how ludicrous this was, and yet that's what they were going out to. Those and the policies added bells and whistles. So, and they said even if they have negative returns from time to time, they had provision for the policy either to lapse, or the owner had to put out more money. The agents earned on those 3 times the commissions that the policyholders normally have. In addition to all that, they could do hyper-funding, take the first few years in payments, and that builds up some cash value, and then borrow against the cash to pay the premiums. And it sounds like you're getting life insurance for no extra cost after paying the premiums for 2 to 3 years. I understand. When I was young and dumb in my 20s, I bought a life insurance policy, and I did that. Hyperfunding. You know who made all the money? The life insurance agent. You know what I ended up with? Less life insurance because I borrowed everything out of the life insurance. It was worth next to nothing by the time I was done. You don't end up with life insurance. You end up with all the money going to the life insurance agent. They make up to 5 times what they normally would. They sell you a $100,000 policy. If they can hyperfund it, they make up to 5 times what they normally would make. You know, it's crazy. Borrowing my own money, paying interest on my own money, and at the end of the time, I get nothing. That's hyperfunding. That was the annuity. I'm going to come back and wrap this up because it's such an important aspect to understand. Annuities up 39% in the second quarter. How crazy is that?
About Money with Mike Adams on AM 1590, The Answer. For more information, click on adamsfinancialconcepts.com.
Taking care of business.
About Money continues. Remember the website, adamsfinancialconcepts.com. Here's Mike.
So, I've been talking about annuities. I've been talking specifically about Pacific Life and the PDX policy. They're being sued for misrepresenting. They're being sued for breach of their fiduciary. They're being sued all over the place because they put out illustrations which were so bogus. Forecasting into the future returns that based on information that no one can figure out, they can't either. Annuities, however, going beyond the PDX Life thing, going beyond that and looking at annuities in general, 39% increase in annuity sale. You know, the fact is, they're sold for one and only one reason, and that is to generate money for the financial advisors. As Owen pointed out in her book, and I mentioned the book at the beginning, there's no such thing as a free lunch. But many baby boomers, people that are focused for selling annuities, do the free seminar. And it's almost always the same pattern. The SEC and FINRA have said that half the flyers are misleading. They say that what you're going to see is low risk. That's misleading. They say they're based on fear. But 9% of the attendees will actually buy an annuity. 9% buy. It's a free seminar. And there's no free lunch in this world. 9% will buy. And the pattern is always the same. It's scripted. It's scripted right down to what is said. The idea is to use fear, to make them sweat a little, to pose a problem. At the same time, the annuity is the solution, but you don't use the word annuity. You want to press the hot button. Will your retirement survive the economic meltdown? Social Security is going to go away. The government's going broke in Social Security. It's going to go away. Government's going broke with Medicaid. It's going to go away. The government's going broke with Medicare. It's going away. And there will be 20 or more slides talking about each of these items. They'll talk about Social Security and the government going broke, and you're going to lose Social Security. What are you going to do? No Social Security? How are you going to retire? No Medicaid. You know, what are you going to do? No Medicare. What are you going to do? They're going to continue to build all that fear. Do you have enough money to get through? Think about how old you're going to live. Will you have enough money to live in assisted living care, assisted living, special nursing? Will you be able to do all that? You know, 47%, they'll tell you, 47% of Americans are going to run out of funds if they retire at age 65. Are you part of the 47%? But you know what? You know what? You have nothing to fear if you plan for it. And then you get the sales pitch for the annuity. That's how they're sold. And you know, you can listen to me on the radio, you can listen to me downplay this, but when you're in the middle of the room, when you're sitting there with 20 other people, and you've got somebody with those slides going up, those PowerPoint projections, or videos talking about it, and they give you illustrations. They'll give you illustrations of people who are destitute, people that run out of money, people that are moving into family homes because they're out of money. And they'll say, you're going to run out of money. But there's a solution. You know, they really focus. And at least 20%, it's inappropriate for at least 20%. Those are the studies. You know, and they say, you can count on this. The annuity, the insurance industry has gotten the regulators to agree that people who are selling insurance product can say your returns are guaranteed. And in the presentation, they'll say they never went broke. Of course, that's completely a lie. Executive Life was the largest insurer in California, did in fact go broke in 1991. The state took it over and paid off the holders. First Capital Life also went broke in that same time period. They had invested in junk bonds, and when junk bonds went south, so did First Capital Life. Mutual Benefit Life was a huge shock to the industry. A+ rated, the very best rated. They were people sold that as guaranteed. They invested in conservative, blue chip stocks, solid bonds. They went broke too. And when that happens, payments are frozen. And they're frozen under a term called extreme hardship. And yes, the payments are guaranteed, but at a reduced rate and a longer time period. So you may be expecting a 5% or 6% under extreme hardship. It's paid out at a 1 or 2% or 0.5%. That's what happens. The insurance companies, the guarantee is a guarantee by a universal life, just like FDIC. And that's what guarantees the life insurance industry. And if they don't have enough money to cover it, then you keep waiting for them to do that out. Baldwin United, huge. 1987 went bankrupt. They were acquired by MetLife, but the payments were delayed for 4 full years. You expected to get 7% or 8% back in 1987? You got nothing for 4 years. And then only a minimum payment, the lowest interest rate possible, which I think in those days was 3 or 4%, which seems wonderful today. But if you were to experience a Baldwin United and not get paid for 4 years and then get the minimum payment of 0.5%, think of what that would do. Annuities are a hard sell. Financial advisors are rewarded very, very well, up to 14%. And rates of, or commissions of 8 to 10% or more typical. When you buy an annuity, when you buy a life insurance policy, when you buy an annuity, there's usually a surrender charge. And it declines by 1% a year, but it begins at 10%. And the reason it begins at 10% is because the insurance company has compensated their advisors, those financial advisors, 10% or 8% to sell the annuity. And if they work for a large company or even an RIA, part of that 10% goes to the company. But the reason there's a surcharge or surrender charge is to recuperate that, so it doesn't cost the insurance company to do that. You get to pay that. And, of course, every year you're going to get at least 1% less than the return on the annuity, on what the company is earning, the insurance company is earning, and they're charging you a couple percent for the insurance. And they're scraping 1/4 to 0.5% off the performance of the mutual funds, if there's mutual funds involved. They're creating a lot of money by doing those annuities. They're not in anybody's best interest. If you're approached by an annuity, call us. We can give you a much better choice. Much, much better. I call them the chocolate-covered hand grenades because they are that. They look so good, and they are so bad. Anyway, don't do it. Don't do an annuity. Don't be one of those suckers that buys that. We have a better choice. Adams Financial Concepts. Have a great week, and I'll be back next week about money.
Listening to About Money with Mike Adams, a registered investment advisor. If you'd like more information about what you heard today, or about Mike's investment philosophy and strategy, or if you'd like Mike to evaluate your own portfolio, click on adamsfinancialconcepts.com. That's adamsfinancialconcepts.com. The information shared in the preceding program was for educational purposes only, and any investment advice given may not be suitable for all investors. Join us again next Saturday at noon for more About Money with Mike Adams here on AM 1590. The Answer.